Gold has been on an absolutely incredible tear. I mean, everybody's talking about it. Prices are just soaring, and it really feels like the safest bet on the planet right now. But when an asset moves this fast, we have to ask a really critical question. Is this a signal of safety, or is it a sign of danger? Okay, let's dive in and figure this out.
First, let's just get our heads around the sheer scale of this rally. In just 1 year, gold has rocketed up by an astonishing 93%. We're talking about a move from around $2,600 an ounce in January 2025 to over $5,000 today in January 2026. This is not a normal bull market, folks. This is what's known as a parabolic move.
And that really brings us to the central question, doesn't it? When you see a chart that goes almost straight up, does that mean you should jump on board before you miss out? Or does it mean you should be extremely cautious? The excitement is absolutely real, but so are the risks.
So to figure this out, we're going to break it all down. First, we'll look at this parabolic rise and what's fueling it. Then, and this is crucial, we'll look at history for its painful but valuable lessons. We'll understand what a crash actually looks like, spot the warning signs for today, and then wrap up with a sensible strategy for navigating this market.
So what exactly is a parabolic move? Well, picture a chart where the price doesn't just go up, it actually accelerates upwards, right? It forms this steep curve of a parabola. It's a sign of intense and often emotional buying. A 93% jump in a single year? Yeah, that fits this high-risk definition perfectly. It's euphoria, plain and simple. And euphoria can be a very dangerous thing.
Now, this massive rally isn't just happening in a vacuum. It's not random. It's being fueled by some really powerful global forces that are pushing investors and even entire nations toward the perceived safety of gold. There are three big drivers we really need to understand here.
Okay. First, central banks are on an absolute buying spree. For the first time in decades, you've got countries like China and India holding more gold than U.S. treasuries. The message there is pretty clear. They're losing faith in the U.S. dollar. Second, geopolitical tensions are sky high. Wars, political uncertainty, it makes the world feel unstable, and it's fueling this trend of de-dollarization, where countries are looking for alternatives. And in that chaos, investors see gold as a rock. And third, there's the mountain of debt. With the U.S. national debt over $38 trillion, there are very real fears that currencies will have to be devalued to pay it off.
So the reasons for the rally, they seem pretty solid, right? But this is exactly where we need to pump the brakes and look at the past. Because, while it's so tempting to think this time is different, history shows us that when it comes to gold, ignoring old patterns can be an incredibly expensive mistake.
Now, what's really fascinating here is the repeating pattern. Look at 1980. After a massive 325% run-up, gold peaked and then crashed hard. Then in 2011, after a decade-long 600% rally after the financial crisis, it peaked again and entered a brutal bear market. And even in 2020, that COVID spike didn't lead to a crash, but to something almost as painful, a multi-year sideways grind. You see the pattern?
So what does it actually feel like when one of these parabolic moves ends? Well, it's not a gentle slope down, I can tell you that. The aftermath can be financially devastating for anyone who bought in late, all caught up in the hype. The pain really comes in two forms, a price crash and a time crash. And this chart just highlights the severity. After that 1980 peak, gold lost 65% of its value. Can you imagine buying at the top and watching your investment get cut by 2/3? After the 2011 peak, it was a 45% drop. These aren't minor corrections. They are wealth-destroying events that can take years, sometimes even decades, to recover from.
And then there's that other kind of pain I mentioned, the time correction. This is when the price doesn't necessarily crash, it just goes flat. For 2, 3, maybe even 4 years, your money is completely dead. While other assets are growing, yours is just sitting there, losing purchasing power to inflation every single day.
This quote from our source material really gets to the heart of it. Gold is a wealth protector, sure, but it has a long history of punishing those who chase it out of pure emotion and that fear of missing out. The crucial thing to remember is the market does not care about your feelings.
Okay, so let's bring it all together. Let's apply these lessons directly to the situation we're in right now in early 2026. Are the same warning signs from 1980 and 2011 flashing red today?
Well, this table makes the comparison crystal clear. Historically, rallies of 60 to 85% have often been followed by a big fall. Right now, we're at a 93% rally in just 1 year. History shows an average correction is between 20 to 40%. For us, that correction is still pending. And the aftermath, typically 1 to 4 years of sideways price action, which is a major risk for new money coming in today.
And here's a critical point a lot of people miss. They think gold is the ultimate safe haven. But in a true liquidity crisis, when the whole stock market crashes, people sell whatever they can to get cash. They sell their winners, they sell their losers, and yes, they even sell their gold. Nothing is completely immune.
So look, the goal of this explainer isn't to scare you, it's to prepare you. Given all the euphoria and these historical warnings, what is a sensible, prudent strategy for someone looking at gold right now? It's not about predicting the top, it's about managing risk.
The source material lays out 4 simple but really powerful rules. 1. Don't panic. Emotional decisions are almost always the wrong ones. 2. Avoid leverage. Borrowing money to buy an asset that's already gone parabolic is just a recipe for disaster. 3. Avoid investing a lump sum. Going all in at the peak because of FOMO, that's how people get wiped out. And 4. Use systematic investment plans, or SIPs. It's just a way of investing smaller, regular amounts so you average your purchase price over time and reduce the risk of buying everything at the absolute top.
And this is what prudence really looks like in practice. Instead of going all in on one hot asset, a balanced portfolio might look something like this. You've got allocations to stocks, bonds, real estate, and in that context, gold and precious metals play a crucial role for balance and protection, not for wild speculation. The source suggests an allocation of around 10 to 15%, making it a vital part of the whole, but not the whole thing.
Ultimately, this fantastic analogy just says it all. A little bit of something sweet is enjoyable, right? But too much can make you very sick. The exact same thing is true for investing in a hot asset. The key isn't to avoid it entirely, but to approach it with discipline and moderation, making sure it contributes to your financial health rather than jeopardizing it. So the question now is, are investors treating gold like a part of a balanced meal, or are they binging on dessert?